much you actually need to live off your investments. Is it 500,000? Is it 1 million? Is it 1.5 million? Is it even higher than that? Because I think this is one of the biggest questions that people ask me and generally worry about when they start investing. Because how realistic is it that they're going to be able to live off those investments at some point in future? But there's a relatively simple rule, and it's called the 4% rule, which I'm going to go into today to work out exactly how much you need invested to be able to actually live off your investments. Hi and welcome back. My name is Zoe and this is my channel Words on Wealth. I'm a former wealth manager and I like to break down all things complex investing topics to make you a more confident investor. So in order to explain the 4% rule, I'm going to take you back to a quick history lesson, specifically to 1994 when a chap named William Bengen came up with this theory of the 4% rule. And the 4% rule was supposed to allow for sustainable levels of withdrawal from a pot of investments that hypothetically lasted for the vast majority, if not all, of someone's non-working life after they'd retired. Basically, in that first year, you withdraw 4% of your total investment pot, and thereafter you continue to do so, but you increase with inflation as well. And the beauty of this is that it allows for a sustainable level of withdrawal. The investments can hopefully continue to grow back and replenish in the year after which you've removed that money. And this means that you've got a pot that hopefully just keeps going. I like to think of it as kind of like pruning a plant. You chop back one leaf, but not all of them, to allow for healthy regrowth on the plant and hopefully a more fruitful and larger plant in the end. I know not all of us are green-fingered, but it's a relatively simple analogy. William Bengen backtested the 4% rule all the way to the early 1920s up to around the mid-1970s. What he wanted to see by backtesting was what actually happens though when the market does, for example, worse than 4% in a year. How does this work? And what they found is that even in bad times, with this 4% rule, it's sufficiently sustainable that actually people can continue to withdraw throughout their lifetime, and in no set of circumstances should it not last more than 33 years. In an ideal case, it would be more, but in the worst case, it would be 33 years, which when we look at average life expectancies tied up with retirement age, which is creeping up, then normally this more or less covers a lifespan at which somebody's working at retirement and continues to live off those investments, that money, until they pass away. So if you're applying the 4% rule to working out how much it was that you'd need, then first you need to find out how much it is that you want, because each and every one of us will look slightly differently on that front. So if you're somebody that, for example, desires around 40,000 a year, then you're going to need around 1 million in a pot. Whilst I use that million figure there for around 40,000, what you would need to do to calculate it is simply take how much it is that you want each and every year and multiply it by 25. And this should give you more or less how much it is that you're going to need to retire. This, of course, is just a kind of plucking a figure from the sky, because what I've not included in that figure is things, firstly, like any existing pensions that you might have in place. So if you're expecting some sort of state pension or other employer pensions to come in, then they would also need to be added into these calculations. Secondly, it also doesn't account for tax, and that is a whole quagmire in itself. I won't go too much into that in today's video because we'd be here for an awful long time just talking about tax in different countries, which sounds fun to some, but not for everyone. But crucially, you do need to factor in a base level. As different pension products, different investment products are taxed in slightly different ways, normally I take 20% as a set rate, unless you know that it's considerably different to that in your country. But it at least helps to factor in some tax that will be going out. So the cynics out there will probably already be thinking, this sounds like it's not really going to work. Because what happens when the market crashes? What happens about inflation, as I've just mentioned there? What happens when your spending isn't constant, like you suddenly hit later life and you have higher medical costs, or you just don't know how long you're going to live? What if you live to 110? How on earth are you going to make that money stretch when we've just said it's a maximum of 33 years? What if you retire at 50? That could be even more years that you're then not working. And I get it. There are some limitations that we probably need to discuss around this 4% rule as well, so that even though it's a great guideline, you can also factor in those variables to your calculations too. This is where what we call sequence of return risk comes in. And this is the risk that two people 20 years apart retire with exactly the same amount inflation adjusted, in those pots. And because of the timing of when the market unfortunately crashed, they can have a very different reality when it comes to withdrawing from those investments. If we imagine that first person retires, markets are buoyant, things are looking good, they withdraw their first 4% and it grows back, it replenishes, happy days, they're fine. Then if we come on to the second person who chooses to retire at that point, that was 20 years before, let's say for argument's sake, they've retired in the midst of one of the worst economic crashes that we've ever seen. That means that they withdraw their 4%, but the markets continue to go down. So the pot of money that they had has gotten even smaller, and it's going to take even longer to recover, thanks to not just positive compounding, but also negative compounding. The way that this is handled is via the investments that you actually have in your portfolio and how you manage the cash and financing around it. Because remember, William Bergen backtested this 4% rule to make sure that even if you do retire in the midst of one of the worst crashes in the world, that money should still last in a worst case scenario for nearly 33 years. Some critics also say that 4% is a little bit too set in stone. Is to say that actually it can and sometimes does fluctuate depending on market conditions and the like. To make the 4% rule sustainable, ideally your portfolio needs to grow more than 4% to make it last more than those 33 years and to allow it to ride out those both ups and downs in the market. What this means is that you're likely needing to choose a diversified blend within your portfolio. Kind of obvious, it's one of the key things. The 4% rule was originally developed off a 50-50 portfolio, so 50% equities and 50% bonds. Again, if we fast forward to now, given that it was made in the mid-90s, that's probably not quite as realistic. And in truth, it'll be something that changes almost year on year if we look at the different mixes of equities. As we're seeing bonds behaving in ever different ways, I do expect this to change. But the key takeaway for me is still that you need that diversified blend. When it comes to actually living off your investments, what people often tend to do is choose to take a combination of income that has been generated by the investments and to sell some of the stronger, higher performing ones. This means that they have a combination of removing the income and also taking away a little bit of the growth, but not too much. If you think of it as like a pie chart, if 50% for argument's sake is generating income, you take that income away and don't reinvest it. And if 50% is growing, likely at a quicker pace than what the income is generated, what that means is that you're selling a little bit of it and allowing it to grow back. Usually when people are in an accumulation phase, so they're growing their investments and not yet withdrawing from them, they lean much more heavily on high growth assets. This is things like stocks in more risky areas and less like bonds and strong dividend yielding stocks. As and when you move towards withdrawing from your investments, what a lot of people tend to do is move towards bonds that generate an income and move towards stocks that generate a steady dividend as well. This combination then allows for, I'm going to say it again, a steady withdrawal from those investments. So if I as a former wealth manager was working out how much I need in investments to live off them and then trying to strategize how exactly I'm going to do that, here's what I would do. Firstly, I do that golden calculation. Take your number and multiply it by 25 to start with at least the figure that you're going to be working towards. If I was then getting really into the numbers, I'd then factor in inflation as well. And honestly, there are loads of online calculators that can help you do this really simply to work out what that figure is going to need to be in X amount of years. As and when I neared the point that I was starting to withdraw from my investments, I would then start to think about my financial management and cash management positions. I'd likely start to withdraw more cash when markets were going well in the kind of 2 to 5 years potentially in the run up to withdrawing from those investments. This buffer would then mean that actually if things were down, as and when I reached the point that I was going to start to need to withdraw from my investments, I have something there that I can then live off. Granted, they won't be growing quite as much at that point, but this is all part of the overall smoothing. The next thing I would then do is see that 4% as a guide and not a hard and fast rule. I try, wherever possible, to withdraw flexibly, depending on the market conditions. Perhaps some years you are able to withdraw more like 5% because the portfolio has boomed and grown 12, 15%. And some years, actually, you have to accept that you can only withdraw 3% and the remainder of your income has to come from the cash buffers that you've built up over the period in the run-up to and then withdrawing from your investments. So there you have the 4% rule in its completion. Hopefully that's given you a figure that you can work towards in terms of knowing how much it is that you need to be able to live off your investments and knowing how that's structured as well from an investing perspective. The goal isn't to build a portfolio that is bulletproof or market proof or entirely in cash. The goal is to build a portfolio and a strategy that can weather whatever life and the stock markets have to throw at us. Thanks for watching. Do make sure you like and subscribe if you're enjoying these, and let me know in comments what you think of the 4%.
This is placeholder media that you'll see if you add a layout to an empty scene. You can go ahead and delete it.